The year is 1720, London. A man stands in a crowded exchange hall, sweating and trembling. This man is arguably the most intelligent human being to ever walk the earth. He invented calculus before 26. He unlocked the secrets of light, gravity, and the universe. He is Sir Isaac Newton. If intelligence equated to wealth, he should be the greatest investor of his time. He can calculate the orbits of planets years in advance. Surely he can predict a stock price. But today, Isaac Newton is not calculating the trajectory of a comet. He's watching his life savings evaporate. He had invested in the South Sea Company. Early on, he profited and sold, feeling like a genius. But then he watched his friends, people far less intelligent than him, get filthy rich as the stock kept climbing. His ego snapped. The smartest man alive succumbed to the fear of missing out. He jumped back in at the absolute peak, investing everything. Days later, the bubble burst. Newton lost £20,000, over $4 million today. Wiped out and humiliated, he famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." This story introduces a paradox that baffles economists, the IQ trap. We're raised to believe being smart solves every problem. To be a rocket scientist or surgeon, you need a high IQ. Naturally, we assume that to get rich in the stock market, you need to be smarter than everyone else. But the data disagrees. Research shows almost zero correlation between IQ and investment performance. In fact, it is often negative. Doctors, engineers, and scientists, people used to being the smartest in the room, are often terrible investors. They trade too often, take illogical risks, and underperform the market. So here's the mystery. Why do smart people do stupid things with their money? And how can you avoid it? The answer lies in a dangerous mental glitch called the complexity illusion. To understand why smart people fail, look at the IQ brain. It is a pattern recognition machine. Intelligence is the ability to look at chaotic data and find the rule. In physics, this works. Drop an apple 10 times, it falls 10 times. Find the formula, you win. Smart people approach the stock market like a physics problem. They study earnings and economic indicators, thinking, if I study hard enough, I will find the formula. But they're making a fatal error. The market is not a physics problem. It's a biology problem. The market isn't driven by immutable laws. It's driven by the emotions of millions of panicked, greedy, irrational monkeys in suits. It's a complex, adaptive system. The moment you find a pattern to exploit, the market adapts and the pattern disappears. But the smart person cannot accept this. Their ego refuses to believe there are problems they cannot solve. When they lose, they don't think the market is random. They think my model wasn't complex enough. They dig a deeper hole, building elaborate theories to explain why they're right even while their bank account hits zero. This is the complexity illusion, the belief that a complicated solution is always better than a simple one. This brings us to the second fatal flaw, rationalization. You might think being smart makes you objective. Psychology says the opposite. Being smart just makes you better at arguing, usually with yourself. When an average person makes a bad investment, they think, oops, I made a mistake, and sell. They have no ego attached to the trade. But when a genius fails, they don't admit a mistake. They use their intellect to construct a bulletproof narrative about why the market is wrong and they're right. They tell themselves prices are down due to a temporary liquidity crunch disconnected from the fundamental asset value. It sounds sophisticated, but it's just a fancy way of saying I'm in denial. Intelligence does not protect you from emotional biases. It gives you the tools to justify them. A high IQ acts like a lawyer for your emotions. Your greed decides to do something stupid, and your intellect writes a legal brief explaining why that stupid thing is actually a stroke of genius. We saw this play out in 1998 with long-term capital management. This was the dream team of finance. The board included 2 Nobel Prize winners and the highest collective IQ on Wall Street. They believed they had solved the market with a formula that couldn't lose. Confident in their genius, they leveraged their bets to the moon, borrowing billions to bet on tiny bond price discrepancies. For a few years, they looked like gods, making massive returns. Then, the Russian government defaulted on its debt. It was a Six Sigma event, something their model said was statistically impossible. But in markets, the impossible happens about once every 10 years. The market panicked, the discrepancies widened. Because the geniuses were so leveraged, losses spiraled instantly. In weeks, they lost $4.6 billion. The smartest men in the room nearly destroyed the global financial system, requiring a Federal Reserve bailout. Why did they fail? They confused the map with the territory. They confused their mathematical model with reality. They lacked humility. This leads to the third trap, the illusion of control. High IQ individuals are used to controlling outcomes. Study harder, get better grades. Work harder, get promoted. They believe effort equals control. But you cannot control the stock market. You cannot control interest rates, the Fed, or a war in Europe. The average investor knows they're powerless, so they're cautious. They diversify. They buy index funds. The genius thinks they can time the market. They treat it like a chessboard. But the market isn't chess. In chess, you see all the pieces. In the market, half the pieces are hidden and rules change every 10 minutes. This overconfidence leads to overtrading. Data is clear. The more you trade, the lower your returns. Who trades the most? High-income, highly educated men. They check portfolios daily. They react to every headline. They think by doing something they add value. But in investing, activity is the enemy of returns. The genius is frantically buying and selling, racking up fees, while the average investor who bought the S&P 500 and went fishing is beating him by a landslide. So if being smart is a liability, should you try to be stupid? No, you need to redefine financial intelligence. Warren Buffett said, investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble. Real financial genius is not computing power, it's emotional discipline, character, not intellect. How do you escape the IQ trap? First, adopt radical simplicity. The smartest strategy for 99% of people is boring. Buy a low-cost, diversified index fund, automate it, and never sell. To an IQ person, this sounds insulting. Their brain screams, "I can do better than average." That's the ego talking. Suppress it. Accept that average market returns, 8 to 10%, will make you incredibly wealthy over a lifetime. You don't need to beat the market. You just need to survive it. Second, create guardrails. Your brain will trick you with complex narratives, so you need rules to prevent action. I will never sell a stock because of a headline. I will wait 24 hours before any trade over $1,000. I will check my portfolio only once a month. These rules are a straitjacket for your inner Isaac Newton. They stop you from panicking during crashes or going all in during bubbles. Third, focus on what you can control. You cannot control returns or the economy, but you can control your savings rate, your fees, and your taxes. The genius obsesses over predicting the next recession. The wise investor focuses on spending less than they earn and investing the difference automatically. Let's return to Isaac Newton. After the South Sea bubble, he lived comfortably but never recovered the massive wealth he lost. He died a genius but a financial failure. Contrast him with Grace Groner. Grace was not a genius. She was a secretary. She lived in a small cottage and bought clothes at garage sales. She never took an economics course. But in 1935, she bought 3 shares of Abbott Laboratories for $180. And then she did nothing. She didn't trade. She didn't read the financial news. She didn't panic. She held through World War II, the 1987 crash, the dot-com bubble, and the 2008 crisis. She simply reinvested the dividends. When she died in 2010, her portfolio was worth $7 million. Grace Groner defeated Isaac Newton. Why? Because she understood that time is more powerful than timing. She understood that patience is more profitable than intellect. The market doesn't care about your GPA. It asks a simple question. Can you handle the pain of doing nothing when your emotions scream at you to do something? If the answer is yes, you will win. If the answer is no, it doesn't matter if you're the smartest person in the room, you will eventually transfer your money to someone more patient than you. So next time you feel the urge to outsmart the market, remember Isaac Newton. Take a deep breath, step away from the charts, be humble, be boring, and let time do the heavy lifting. Because in the world of money, the tortoise doesn't just beat the hare. The tortoise ends up owning the racetrack. If you want to master your own psychology and invest with the wisdom of Grace rather than the ego of Newton, make sure you're subscribed. Thanks for watching.